Hello guys, it's been a while. Hope you guys are doing well, especially in the forex market. I've been away for some time now, although I've been very active on our institutional data Telegram channel where I share daily institutional pending and active orders, price magnets, VIP buyers, which is basically active demand and supply. And recently I started sharing intra-week contract market direction based on our interpretation of the institutional data. If you are not on that channel, you are missing out because so far we've shared 18 intra-week contract direction. That is 9 weeks of active trading, and we were right 17 times out of 18. That to me is A plus level of accuracy, meaning institutional data is a real forex trading cheat code. If you'd like to join the channel, the link to join is in the description of this video. In today's video, I'll talk about market makers and institutional traders. I'll cover who they are, what they do, their role in the forex market, and a lot more. Basically, all you need to know about the market makers and the institutional traders. So without wasting much of our time, let's jump right into the video. So who are these two very important major participants of the financial market? Let's start with the market maker. A forex market maker is a financial institution or a broker that facilitates the trading of currencies in the forex market. Market makers are primary participants in the market. They provide liquidity to the market. They are always available to buy or sell any currency pair at any time, regardless of where price is headed. This may sound strange to some of you because of the misinformation out there that market makers move the market and are responsible for running stop losses. This is not true. In reality, market makers are the reason why traders can place trades at any time and their trade will be processed. That's because the market makers take the opposite side of the transaction. If you've seen some of my old videos, I explained how buy and sell must be equal for a trade to happen, which means for every 10 lot buy, there is an opposing 10 lot sell paired with it for that trade to be executed. With this information, it is clear that the task of getting equal and opposite volume of orders at the same time on the same pair in the forex market is practically impossible. So in order to maintain transaction flow in the market maker is born. They take the opposite side of trades when there is no opposite order from traders. Let me explain this with a practical example. Let's say as at 8 a.m. on Monday, the total orders placed by traders on Euro USD is 1,000 lots, out of which 700 are for buy and 300 lots are for sell. Remember that for a buy to happen, there must be a seller in the same quantity. This means the 300 lots of sell orders will be paired with 300 lots of buy orders out of the 700 lots total. In a market without market makers, only the 600 lots paired orders will be activated, leaving the remaining 400 lots declined or cancelled. In this kind of situation, trading becomes first come, first serve, leaving most traders frustrated. That's why the market makers exist. The market maker in this example will have to sell 400 lots on Euro USD so that the leftover 400 lots buy trade by the traders will be executed. The market maker have to take the sell trade even when they know price will go up, contrary to what you must have heard about the market maker. They don't trade for profits. They trade to ensure trading activities flow smoothly by providing liquidity. At this point, I'm sure you have some questions on your mind. That's because the situation leaves us with two big questions. The first one is, how do the market makers make profit? And the second question is, what happens to their trades, especially when in drawdown? I'll be answering these questions in a moment, but for now, I want you guys to like the video. If you haven't subscribed to the channel, do that right now. Click the subscribe button and turn on your post notification so you don't miss out any of our eye-opening contents. Back to the questions. The market makers make profit through spread and commissions. I believe most of us know what spread is. For those who don't, spread is the difference between bid price and ask price. It is why every trade we open starts in drawdown, meaning our sell trades are opened at a price slightly lower than the current market price when the trade was initiated, and our buy trades are opened at a price higher than the current market price when we open the trade. That little loss is the profit of the market maker. In addition to this, when the trade goes in their favor, they get to close it in profit when the opposing trade taken by the trader is closed in loss. That settles the transaction in a profitable scenario for the market maker. This leads us to the second question on what happened to their trade when in drawdown. In this situation, the market maker holds the trade in drawdown and buy back the position of the opposing trader when the trader decides to take profit. This leaves the market maker with two trades, with one in profit and the other in drawdown. The market maker holds on to these positions until the market retraces back to the original opening price, where they collapse all the positions, one in profit equivalent to the profit made by the opposing trader and the other one at break even. This is what we commonly refer to as trade mitigation. 95% of the time, price will return to the opening price, allowing the market makers to mitigate their orders. The 5% left is the risk on the market maker. That's when they close in loss, which they make back when traders lose. So how do we at Tom's Capital take advantage of all this? With access to institutional data feed and the analytical softwares that we use, we are able to track market makers' positions from the open of a contract to the end. This helps us to determine when the market maker is holding a trade in drawdown, meaning the opposing trader is in profit. These situations only means that the market maker will need price back at the opening price of the order so that they are able to mitigate their position after the opposing trader takes profit. The opening price in this scenario is what we mark and report as institutional price magnet. This is one of the data that we share with the members of our data sharing Telegram channel. The link to join that channel is in the description of this video. It is free for now and will only be available to a limited number of traders because this kind of information is not meant for the whole trading community. Now to the institutional traders. They are a very big part of the market. They are the major counterparty to the large banks and the dealers. They are also referred to as asset managers or large speculators. They are in the forex market to make profit from their trades. They trade really huge positions capable of influencing price movement, so they make profit on almost all their trades, which is why we track their positions in the market. Those in this class of traders are the pension funds, the mutual funds, and institutional investors. They are responsible for the accumulation and distribution phases in the market. When they place a trade in the market, price will head in that direction 85 to 95% of the time. Because of this, we as retail traders need to track their positions and trade in line with them. The institutional traders work hand in hand with the market makers as they are mostly members of the same institutions but in different departments. Knowing this for a fact, it will only be to our advantage to analyze the market using the activity of these two major players. For the market makers, we identify the opening price of their drawdown trades that will need mitigation in future. This we mark as price magnets. However, for the institutional traders, we monitor their market orders and limit orders so we know where and when they open new trades and set new pending orders. So anytime they open new trade and back it up with pending orders for accumulation of more positions, we mark that and report it as institutional pending order. This is the second data we share with our subscribers who join the data sharing Telegram channel. The third data we share is the VIP bias, which is a price analysis based on volume and open interest, hence the name VIP, which stands for volume, open interest, and price. This helps us to confirm when price is ready to reverse in the direction of the institutional orders to target the price magnets to help the market makers mitigate their positions. So the VIP bias is basically like the active supply and demand that shows us aggressive selling or aggressive buying. This will be the end of the video. I have made a couple of videos where I showed all these on the chart and explained how they affect or influence price movement. Do well to watch those videos after this one. Don't forget to like, share, and subscribe. If you have any question, you can ask in the comment section of this video or message me on Instagram at Tom's Capital. I'll see you guys on the next one.